Good evening, everyone. I hope I'm audible to all of you. May I get a quick confirmation over the chat box. Audible to all. Awesome. So we've made to the Zoom as well as YouTube. So I hope all the YouTube people are also able to hear me. Just a quick confirmation on the YouTube chat as well. Awesome. Okay. So we are audible to all, and I welcome you all to our day 2 of SBR Marathon, where we are going to cover our question practice. So before I start with our today's session, where I will do December 2023 past paper, I want all of you to open this paper in front of you also. Okay, so I'm going to share my screen, no doubt, but I want you guys to have this as well so that you can together with me solve that question maybe on your CBE platform, and you can side by side do that question along with me if you're working on the dual screen. That's what students usually do in live classes. So let's get started. Please let me open the CBE platform on my end. You guys can also open it. Let's take 2 minutes and open our CBE platform. Yes, everyone on YouTube as well. Come on, let's practice December 2023 paper. Okay. So here is your CBE platform. This is our CBE platform, okay? And let's go on to our first question for the day. Question number 1, which is on pre-populated spreadsheet. So I hope I'm visible to everyone on YouTube as well. So let's see. Okay. This is our first question for the day, where we are going to do group statement of cash flow. So everyone who's here in the Zoom meeting, I request you to keep your calculators with you. Okay, wherever I would ask you what is this, what is that, you're going to reply me on the chat box and you're going to help me in the calculations. So let us see what's there. Our first way of doing techniques that we learned yesterday. First, we need to copy all our exhibits requirement in our response option. So that's what I would do. But you know what is the terrible thing over here? Whenever I would do this, there would be some formatting required. So we are going to do this formatting over here. See, my first requirement is adjust the pre-populated spreadsheet. My second requirement is explain the adjustments. My third requirement is about something related to explanation part once again. So I'm supposed to deal with this whole thing. Now, okay, yeah. Now, what I'll do is, what's my second step? Step number 1, copy paste. Step number 2, please bold the letters and understand the requirement completely. So let us understand the requirement. Here they're saying, using exhibit 1 only, adjust the pre-populated spreadsheet. So I will bold this verb of adjust. That's what I'm supposed to do. I need to adjust. What I need to adjust? I need to adjust pre-populated spreadsheet. So this is something that is the content, subject matter, pre-populated spreadsheet. To prepare revised extracts of operating and investing activities. So which two activities am I talking about? Operating and investing activity. in my group statement of cash flow. Fine. And what is the mark allocation for this? The mark allocation is 14 marks. Wow. 14 marks only for the adjustment to the pre-populated spreadsheet, which is a huge, huge deal. Then explain the adjustments required. So now they're asking me to explain whatever I have done above. So explain the adjustments. What is the subject matter? Subject matter is the adjustments which we have done above. Required to correct the operating and investing activities. So they're just asking me about, once again, operating and investing activities. That is for 10 marks. So 10 marks means I need 10 relevant explanations. I need 10 relevant points because there is 1 mark for each point that I write. So I need 10 relevant points. Okay. Then what do we have next? Let us see what's next. Then they're saying, okay, using exhibit 2. Now from here, exhibit 2 will start. Advise the financial controller. Advice means discussion. Once again, the financial controller would be doing something fishy in the the case study, and we will comment that, dude, you're doing this wrong. You need to improve on this. You need to improve on that. This is incorrect treatment. That's not how you treat it. So that kind of advice is needed over here. So advise the finance controller as to how various financial instruments, including the overdraft. So one, I have to talk about financial instruments. Secondly, I'm supposed to talk about the overdraft. So there are two contents over here. Should be presented in the cash flow. So they're asking you how to deal with financial instruments in the case study and overdraft in the case study in my statement of cash flow. That is what they're asking me. So let's see. Let's start reading our question. So what we will do, this is a word processor where we have just, listed down our exhibits, our requirements. So first requirement don't need any explanation. It needs just pre-populated adjustment. Second requirement need 10 points. So I will write 10 points over here, right? So bullet points I can write because there's no professional marks over here. Then in exhibit 2, 6, I need 6 points to explain the financial instrument part and the overdraft. Partly we discussed this overdraft thing yesterday in our marathon. So I hope you guys remember that as well. So let's see what do we have for our first exhibit. But before that, let us first read the background. So background says, Goodwill company is the parent of a group whose financial year end is 31st December 2005. So this is something I should be highlighting. This is my year end. The following exhibits are given. First exhibit relates to acquisition of a subsidiary. So this is group accounts. We are preparing cash flow. So there is a subsidiary that we've purchased during the year. So that's what it relates to. Then we have financial instruments. You need this exhibit 2 in your second requirement, right? So this is given to you. Then they've given you pre-populated spreadsheet, consolidated financial statement. So see, you can check here. Here is your pre-populated spreadsheet given to you as it is. So this is our pre-populated spreadsheet. I hope you all can see. This is my pre-populated spreadsheet. They've already given me the cash flow from operating and investing activities. I'm just supposed to make adjustments to this, right? And there are some few things which needs to be added as well. So there are adjustments and there are some things that I need to add or remove. So that's why some rows are left blank, right? So this is very interesting. Let us see what do we have. First of all, let's go to our exhibit number 1. First exhibit talks about Goodwill company which acquired 80%. So always keep your exhibit over here on the right side so that this section of your paper is handy. And while I start solving this, I need to understand that the second part, the explanation part, requires me to explain the adjustments only. So there's no point of reading this exhibit with the perspective of sentence formation, with the perspective of explanation. Because at the end of the day, I have to explain my adjustments only, and that is a very simple task. If I've already adjusted something, I can explain that thing also. So I will read this full exhibit from the perspective of my pre-populated spreadsheet. So I will keep pre-populated spreadsheet in front of me and I would read this exhibit. So let us see what we have. Cabello Company acquired 80% of 1 lakh equity shares of Trudis Company. So Cabello becomes the parent apparently and Trudis becomes the subsidiary. The consideration consisted of a cash payment of $5 per share acquired. So I have paid $5 per share and an issue of one of Cabello's one equity share for every 4 shares acquired. So now I want you to reply to me. When you make share for share exchange, that means when you give out your own shares to the subsidiary in form of consideration, is that a cash flow? Is that a cash flow? When you issue shares, when you issue share to the subsidiary to take the shares in that company, is it a cash flow? No, it is not a cash flow. Rather, it is something which is non-cash thing. I will not account for it. So what I can do is in my word processor, first I can explain these things. First point that I can explain is about explanation which is required. So if I just check out my spreadsheet in my investing activity, have they given me consideration? See, they've given not yet calculated. So here you are supposed to calculate it. Can you see? The question is saying not yet calculated. So if something is not yet calculated, what are you doing in the exam? You're supposed to calculate it. That's an adjustment, right? So I will calculate this. So we need to calculate this. Therefore, everything related to the acquisition is something which is an adjustment. So first I'll explain the acquisition of a subsidiary in a group statement of cash flow is treated as, when you acquire a subsidiary, is it an inflow or an outflow? The money that you pay to acquire a subsidiary, is it an inflow or an outflow? Awesome, it's an outflow. Is treated as a cash outflow in which activity? Which activity do you record this? In investing activity. In investing activity. That's my first point. However, this is to be taken at net amount. So I can make another point out of it. Just writing that this goes into investing activity and it's an outflow is something which makes sense and gives me 1 mark. Second point I will write that when a subsidiary is acquired, or let's make it more relatable, what is the name of our subsidiary? Trudis Company. When Trudis Company is acquired, the cash outflow is reported at net amount because logically, if cash goes out to buy a subsidiary, then the subsidiary is also bringing its own cash and cash equivalents along. Therefore, the net cash outflow is calculated or is reported. Now we will calculate the net cash outflow on the acquisition of this company. But before that, we know how much consideration we are paying. There is a cash consideration which is directly a cash outflow. But over here, we will also write that the share for share exchange. Please use the full form. I'm writing in short. The share for share exchange as paid as a consideration to acquire subsidiary or to acquire Trudeau's company is not a cash flow and therefore does not impact group statement of cash flows. So this does not impact my group statement of cash flow because I'm not giving out cash. I'm rather giving out my shares. So let us do the calculation bit now. We've done the explanation bit for whatever we read. This is how we move in the direction of the case study. Now let us do its calculation bit. So when we have acquired this, we paid cash. So how much cash have we paid? Let's do a working. So we all know when we acquire a subsidiary, we are supposed to calculate something which is very important. What is that something which everyone calculates on acquisition? Come on, what is that something? Goodwill. So we have to calculate goodwill. And plus you can see they have given you some goodwill in the question also. They have given you opening balance of the goodwill and they have given you the closing balance of the goodwill as well. So this means, can you see that your goodwill is increasing? Your goodwill is increasing. So we need to calculate the goodwill on acquisition so that we can actually calculate what was the goodwill impairment. Because if you see the question, have they given you any impairment as non-cash? They've not given you non-cash impairment here. They've just given depreciation. So that means I'm supposed to calculate this impairment. It's a must. So let us write here impairment of goodwill. This is something I'm supposed to calculate because it's a non-cash thing which is added back to the PBT. So I need to adjust it non-cash. That's why they've given me this. So what I will do is, even if I don't know this, what I can do is I calculate goodwill on acquisition so that I know what's happening. So let us calculate goodwill on acquisition of whatever the name of the company is, Trudeau's company. How we will calculate, what is the formula? Fair value of consideration paid by the parent. Fair value of consideration paid by the parent. There are two types of considerations in this case. Cash consideration, share for share exchange is there. Then you add NCI to this. We need to see what is their valuation policy of NCI. Are they calculating it as a percentage of working note number 2 or are they calculating it as fair value? So that is something which we need to fix for ourselves. Then what do we have? We have working note number 2. So from this you deduct less. What do you deduct? Fair value of net assets of the subsidiary at acquisition date. At acquisition date. So you're supposed to deduct that. Correct? So that is something which might not be given. So right now I've just read something which is related to consideration. So what is my consideration? Cash consideration. Come on, exhibit 1. Cash consideration is $5 per share acquired. So I am getting 80% of 1 lakh shares. So how much am I getting? I'm getting 80% of 1 lakh shares. So let's put our formula here. It is 80% of 1 lakh shares, right? And what is the share consideration that you're giving? You're giving $5 per share. So how much cash have you paid? You've paid $4 lakh. So 4 lakh is your cash consideration. 4 lakh is your cash consideration. Then what do you have? Share for share exchange is there as well. So what is the condition for share exchange? They are saying you are going to issue 1 equity share for every 4 shares. So the ratio is 1/4. And your policy is to value NCI at fair value. So you are calculating which type of goodwill? When I value NCI at fair value, what type of goodwill is this? Fair value goodwill, full goodwill. And how do you value the fair value of NCI? They are saying please take the share prices of parent and subsidiary as $13 and $8 each. So what I will do, come back to my calculation part. I will say how many shares have I acquired? I have acquired 80%. I've acquired 80% of 1 lakh. And how many, what is my ratio? It's 1/4. And what is the share price of the shares that the parent is issuing? Parent is issuing its own shares to the subsidiary. The share price of parent company is $13. So multiply this with 13. Your value for share exchange comes out to be 2,60,000. So your total consideration paid is 4 lakh plus 2,60,000, which is 6,60,000. This is the total consideration paid. But only 4 lakh out of this is cash consideration. This will affect the cash flow statement. This will not impact the cash flow. Will not impact cash flow. Right? That's what we've explained in our explanation part. Then how do we value NCI? Come on. It is 20% of total shares which are 1 lakh. And what is the value of NCI share, subsidiary share? $8. So this NCI comes out to be 1,60,000. So what is the total amount parent and NCI have paid to acquire subsidiary? They have paid 6,60,000 plus 1,60,000, which is 8,20,000. This is the total amount both parent and NCI have paid to acquire the subsidiary. Very simple. 8,20,000. Now what I need to do is I need to calculate the net assets of the subsidiary at acquisition date. So what is given to me with regards to that? Let us see. They are saying the net assets of the subsidiary on 30 June. 30 June is the acquisition date. So this is the acquisition date. And what was your year end? Background was giving you the year end. What was your year end? You highlighted that. Come on. What's the year end? 31st December. So when are you acquiring this subsidiary? How many months into the year? How many months into the year are you acquiring this subsidiary? 6 months into the year. Very good. So it's a mid-year acquisition, just for your, memory. Keep that in mind. This is a mid-year acquisition. So here they're saying the carrying amount of the net assets is 7,47,600. Fine. So this is very easy. But they're saying there's a fair value adjustment. What is the fair value adjustment? It is of 50,000. So 50,000 is my fair value adjustment. The group pays tax at 30% and deferred tax was correctly accounted within consolidated financial position. My question to you, why they have given you this? Did they have a mood swing? Why did they mention this? What's their agenda? What they want you to calculate or what they want you to understand? Very good. When I make fair value adjustment, whenever I'm making fair value upliftment, I am supposed to calculate my deferred tax liability, because when you acquire the subsidiary, you are taking the subsidiary's assets to fair value. Tax authorities are not doing this. They do not know about this whole thing which you are doing. So the tax base is constant, but you have taken the book value of the assets at an above amount by 50,000. Which practically means that my carrying amount is coming out to be greater than the tax base, which gives rise to deferred tax liability. So I will calculate my deferred tax liability. See how I'm going to do this. So come to our working. Let's do our working over here. We will calculate it here only beneath this. We can say the carrying amount of net assets as per question is given to be, we can do it in inner column, 747,600, right? And then what do we have? We have a fair value adjustment. So there is a revaluation. Which is the revaluation? It is 50,000 upliftment. So an increase by 50,000. Then they are saying there is deferred tax liability which needs to be created. When I create a DTL, am I supposed to add it to the net assets or deduct it from the net assets? Yes, am I supposed to add it or deduct it? Very good. I'm supposed to deduct it because liabilities reduce net assets. Net assets are happy things. Net assets, net happiness. If you increase your liability, you will be sad. So you need to deduct it, get rid of it. So what is my deferred tax liability here? Put a negative sign. It is calculated as 50,000, 30%, which is the tax rate. Because 50,000 is the temporary difference. So my deferred tax liability is 15,000. So what is my fair value of net assets at the acquisition date? It is, just add all of them. You get 782,600. So what is your goodwill on acquisition? What is our goodwill on acquisition? Goodwill on acquisition. So goodwill on acquisition is simple. We are having this plus, okay. We are simply having this minus fair value, which is 37400. This is my goodwill on acquisition of the subsidiary. Now guys, what are we supposed to do? We just read it till here and this is what we've calculated. Now they're telling you with respect to cash flow, but let's take it into cash flow also. So when you acquire a subsidiary, you are supposed to take out in the investing activity. Can you see this is investing activity? Consideration paid for the acquisition of this subsidiary. How much am I supposed to take? Let's see. We will say total cash paid. So total cash outflow, how much is that? The total cash outflow is 4 lakh. But how much cash is subsidiary bringing along with it? 24,900. Subsidiary is bringing 24,900 cash and cash equivalents. So what is my net cash outflow? I will write that here. My net cash outflow over here. So all of you know that this is an outflow. So I'll put it in negative amount. What is, we can do it here. It is a negative amount. So 4 lakh is the cash consideration which we've paid to acquire the subsidiary, and subsidiary is bringing along with it 24,900 cash and cash equivalents. So the net amount which is going out of my bank account is 375,100, which is an outflow. Therefore, I've written a minus sign in front of it. Right? So what you can do is you can, if it allows you to, okay, this is editable. Fine. So I can just copy this here. Yeah. So this is my net cash outflow. This is how I've calculated it. So you can just bold this. 375,100 is going out. Awesome. Next, what do we have? Let's read the question ahead. See, they have given you goodwill, opening goodwill and closing goodwill. So what you will do? You'll write that also. So you'll say that, ma'am, my opening goodwill, group goodwill was opening group goodwill. Because group does not just have one subsidiary, which is Trudeau's company. It might be having many other subsidiaries as well. So my opening goodwill as per the question which is given to me is how much? What's my opening goodwill? It is given here. We can simply copy 441100. So my opening goodwill is, let's copy that cell to avoid any misstatement or error. This is my opening goodwill. So in that I will add goodwill on acquisition of this company subsidiary. What was the goodwill on acquisition of this subsidiary? We just calculated over here 37400. So my closing goodwill as per my calculation should come out to be opening goodwill plus the goodwill acquired during the year, which is 478,500. So I should get this much goodwill. But then guys, I also am given closing goodwill in the question. So let us see if my closing balance matches the examiner's closing balance. So examiner has given you the closing balance of the goodwill as 447,400. Once again, let's copy it. So it is 447,440. Is it matching? You thought this will be your goodwill, closing goodwill. Examiner said no. This is the actual closing goodwill. Your goodwill is lesser than what you expected. Your goodwill is lesser than what you have expected. What could be the reason for this? Impairment. Very good. So the only thing which remains is my balancing figure, which is impairment. So this is a balancing figure over here. So balancing figure, impairment of goodwill. So what is this? This is coming out to be how much? What is the impairment here? This minus this, which is 311,100. So 31,100. What should I do with this impairment of goodwill? Quickly, what should I do with this impairment of goodwill? It's a non-cash item. I need to add back to my PBT in operations. So let's add back here. So put an equal to sign here. Go back to your working note to avoid any misstatement. So it is, yeah. So what it is, we need to add this back. So you can just simply put a minus sign in front of this. So it becomes a positive 311,100. Or else what you can do is, you can rather write it over here. Positive 311,000 and remove it from here. Okay. Right. So this is my adjustment 1. So let us explain this adjustment in a word processor. So we've already explained everything related to cash consideration. Now let us explain something related to goodwill. In the operating activities, profit before tax is taken as a base to calculate cash generated from operations. However, this profit has a lot of such expenses deducted from it, which are not cash expenses, like depreciation and impairment, amortization. Therefore, the impairment on goodwill needs to be added back to the profit before tax to get the real cash flow. So that's my explanation point. 4 points I've already explained. So see, I'm dealing with 2 requirements simultaneously. As in when I'm reading the case study, I'm dealing with 2 requirements simultaneously. I'm not leaving it for the end. Right? That's how you have to deal with the question. You have to move in the direction of the case study as much as you can deal in all the requirements. Please go ahead and deal with it. Let us read the question ahead. What have they given? The taxation figure in the statement of profit and loss for the year ended was this much. So that means this tax was your charge for this year. That's what you take in your statement of profit and loss. So this year's tax expense was 385,600. And this figure has been included as taxation paid within the draft statement of cash flow. So what do you think? The tax that you accrue during the year is the tax that you actually pay. The tax which we accrue the tax that we, say is the charge for this year, is it exactly the tax that I'm paying? Yes. Is it? No, not at all. So what I need to do, I need to calculate what was the actual tax paid. So let's do that calculation now. Let's make another working note. So what we will do is, see, this taxation paid needs to be adjusted. So our adjustment number 2 would be related to tax. So let us make another working note. Working note number 2, taxation. So what am I supposed to write with regards to taxation? Please, everyone pay attention. Okay. So with regards to my taxation, I will say, let's first talk about our current tax. That means, what was our taxation liability, opening liability and closing liability given to me in the question. So my opening, please do not annotate on the board. Okay, so my opening liability, current tax liability, is, as per the question given to me, it is 256,900, right? And during the year, what is the charge during the year? That means the increase in this year's tax expense is given to me is equal to, what is it? Let us see, it's equal to this one, 385,600. So it is 385,600. That's the charge during the year. What I'm supposed to do, I will compare it with the closing and I'll get the actual tax paid. Another shortcut is, what if I deal deferred tax and current tax along? Because they have also given you deferred tax liability. So what is your opening deferred tax liability? 2,50,000. So come on, write it here. Opening deferred tax liability, 2,50,000. What was this year's charge for deferred tax liability? What was the increase in deferred tax liability? Have you seen any deferred tax liability till now? Where have you seen the deferred tax liability? Yes. Be the Dora the Explorer. Where can you find the deferred tax liability? Can you see deferred tax liability? 15,000 fair value adjustment, this one. So during the year, I increased my DTL. So increase in DTL during the year was 15,000. So I need to add 15,000 over here. Yes. So I get 15,000 here. This is according to me. So in total, what should be my closing balance, total deferred tax and current tax balance? My total should be how much? My total should be, having all of this, 907500. So this should be my total closing liability for current and deferred tax. But as per the question now, let's see what is our total closing, total current and deferred tax liability closing balance. This is just something that I'm preparing, like we prepare T-shaped accounts, no? I'm just preparing it in this format because I'm not able to make a T-shaped account over here. So my closing is how much? Let's see. Deferred tax liability was 1,30,000 and current tax was 3,64,300. So closing as per the question is 4,94,300. So according to you, your liability should have been 9 lakh something, but actual closing balance is 4,94,300. Why did I not adjust the closing balance for this deferred tax liability? Why did I not adjust this? Why did I assume? Why did I assume that this was correctly treated? Because it was given to me in the question. What's given to me in the question? Read this. They said you have correctly accounted for deferred tax in the statement of financial position. So that means in the closing balance that 15,000 was already there. So there's no need to make an adjustment in the closing. So this is the real closing balance. The real closing balance which includes everything. So what is my tax actually paid then? What is my tax paid? Come on. What is my tax paid? The balancing figure is my tax actually paid during the year. How will you calculate it? You'll say, I've paid this minus this, which is 413,200. So this is my actual cash outflow. This is my cash outflow, which should go into operating activities, right? This is my cash outflow. But how much have I recorded as cash outflow for taxation? I've recorded 385600. So this is understated. This cash outflow is understated. I need to figure this out. I need to correct this. How much more outflow is there? What is the difference? Let's calculate. The difference is there's a difference of 413 was the actual cash outflow, 200, and what I have already recorded is 385600. So that means 27,600 is my cash outflow which I have not reported and I was supposed to report as it's an adjustment. So this is the adjustment I've made. So what is my total cash outflow because of taxation? What's my total cash outflow? It should come out to be 413,200. So I think you need to see, add them. It's coming out to be 413,200. So that's my adjustment number 2. Are we all clear on this? Quick confirmation. Are we all clear till here? How's it going? We are understanding it? Thumbs up? Yes? Okay. Awesome. Next. What is given to me? The group financial controller has accurately completed the consolidated statement of financial position and P&L, but the consolidated cash flow is in draft. Okay, whatever. The financial controller has not yet considered the impact of acquisition of Trudus. Fine, this is useless. We don't need this. Then what we have is the statement of cash flow figures for movements in inventories, trade receivables and PPE have been calculated by considering simply the differences in year-end balance and the opening balance. So this is something that you need to adjust, which is your working capital and property, plant and equipment. So what I will do, I'll go to my PPE first. So let's prepare our PPE's working note, property, plant and equipment working note. Everyone, come on. Working note number 3. Working note number 3, PPE. Because they have not taken into account, acquisition of subsidiary. So I need to take that into account. That's a mistake that they have done. So what is my opening PPE? My opening PPE is given to me in the question. So let's give a heading. Opening PPE. During the year, I acquired some PPE. So acquisition, acquired PPE of this company, Trudus, right? Then there must have been some depreciation of the PPE during the year that would be deducted from here. Then there was also a fair value adjustment, right, to the PPE for 50,000. And then I should get my closing. So if that would not match, that balancing figure would either be what I have acquired or it would either be what I have disposed. So closing balance. So what's my opening PP? Let's see in the question. My opening property, plant and equipment as per the draft question is given to me as 3 lakh, this one 125,300. What is the acquired PP? For Trudus, the PP was 421, 4,21,000. So come on, take it here. 4,21,000. Let's write 4,21,000. Right? Then depreciation, is depreciation given to us anywhere? Yes, come on, all the Dora the Explorers. Where is depreciation? Where's the depreciation? Second last line. Depreciation was 6,25,000. So we will treat this as it is. So we'll say our depreciation is 6 lakh. That's a negative balance. So it's minus 625,060. Fair value adjustment was of 50,000. So add 50,000. So what is the closing balance as per you? The closing balance is, just add all of this. The closing balance as per our calculations should be 2971240. But what is the closing balance as per the question? Let us see. So question has given us closing balance of PPE as 3668900. 3668900. So I'll take this as it is. So you thought that your closing balance is 2971240, but actually it is coming out to be 3668900. That means you have acquired PPE during the year. We've acquired PPE during the year. This is acquisition. So what is it? It is cash additions, cash acquisition of property, plant and equipment. So how much is that? It's the balancing figure. What is the balancing figure? It is this minus this, which is 697,660. So bold this. This is the balancing figure which you've calculated. So where will it go? This is investing activity. Is it an inflow or outflow? Inflow or outflow? Very good. It's an outflow. So this will be treated as an outflow in investing activity. So let's see what we have. Acquisition of PPE. We've already recorded that our acquisition of PPE has led to an outflow of 5,43,600. How much it should have been? It should have been 697,660. So what I'll do, I've not recorded all the amount. So let's record the remaining amount. I will say I need extra cash outflow of, my actual cash outflow related to this was 697,660. I've already recorded a cash outflow of 543,600, which means there is an extra outflow of 154,060. Right? 154,060. So what is this giving me? Total, let's see if it matches. This plus this should come out to be that 697 amount. Yes, it's coming out. So are we clear on this? Okay, one student on YouTube has asked Shubham, what about depreciation and fair value adjustment on plant? Okay. Very relevant question. There was a fair value adjustment on acquisition. And this fair value adjustment was related to plant and it was 50,000. Have they given you the life of the plant? Have they given you the life of the plant? If they would have given, you could have said there was an additional depreciation which needs to be recorded, which is not yet recorded. So they've not given us any depreciation point. And yeah, so they've not given us any depreciation point. So they've just given us total depreciation already. So we assume that this depreciation includes the depreciation of that plant. So Shubham, this depreciation is already included in 625,060 because they have nowhere written that we didn't charge extra depreciation. This was the extra depreciation or this was the life of the plant. They've not written anything like that. They've given us closing balance of the depreciation. That means they've already taken that extra one into account. Right? Okay. Let's move on. Lastly, they're saying no disposals were there. So, okay, fine. We've already taken that. Now let's talk about our working capital. Very important for everyone. Before I shut this question up, working capital, they are talking about increase in inventory. Since current asset increases, it's an outflow. Increase in receivable, current asset increases, that means you're buying that asset, therefore outflow. Increase in payables, that means you've taken more money, so that's an inflow, right? So that means we have working capital movement with us. But the question is saying that in your cash flow, you've not dealt with the working capital of the subsidiary yet. You've simply taken in the cash flow. The question never said that they have not correctly counted acquisition of Trigus in the balance sheet or the P&L. The question said that it was not rightly accounted for in the cash flow. So they said everything is accurately treated in P&L and balance sheet, but cash flow is not yet correctly calculated. Right? That's why we assume that depreciation is correct, because depreciation is a P&L item. Correct? So I am supposed to talk about this cash flow figure. What is this cash flow figure here? They're giving me this movement in inventory, trade receivable, trade payable, and PPE have been calculated by simply considering the differences between opening and closing balances. They've not accounted for the movement which related to acquisition of the subsidiary, because subsidiary also brought along with it the working capital. So how do we take that into account? Let me explain this on board to you, then we will do the calculation. Come on. Let me explain this to you on board. I hope the board is visible to all. Yes, visible. Awesome. Okay. So let me explain this to you. When you acquire a subsidiary during the year, what happens? Your opening balance, does it include subsidiaries accounts? Does it include subsidiaries inventory and receivables? No, it does not include subsidiaries balances. Closing, will the closing balances have subsidiary? Will the closing balance have subsidiary? Yes. So subsidiary is not there in opening, subsidiary is there in closing. So can you compare these two amounts and get your actual cash flow? Can you compare this amount and can you get actual cash flow? If you have missed on anything, move to the YouTube live. YouTube live can be, you can go to the previous part that is covered so you can understand from there. It's there on my channel. So when I compare this opening and closing, I need to compare like for like. I cannot compare someone who's in 8th standard with someone who's in 10th standard and conclude this person is intelligent, that person is not intelligent. They both have different capacities. So in this case, when I compare my opening, I need to adjust my opening. So I need to add subsidiaries, working capital or current assets or current liabilities to this so that I get an adjusted opening balance. And this adjusted opening balance is going to get compared with the closing balance. So adjusted will be compared to closing balance and that will give me the real cash flow. So what I'm trying to say, whenever you acquire a subsidiary, what's your way of calculation? You say an opening balance is given to me in the question. In that opening balance, I add subsidiaries inventory. If I'm talking about opening inventory, so I will add subsidiaries inventory to this. This will give me adjusted opening balance, which will be compared with the real closing balance. And this will give me the actual cash movement. Closing minus opening is the movement formula. Now, in this question, have they given you actual opening or actual closing balances? Have they given you group inventory, group trade receivables, group trade payables? All my students, you also not done such kind of a question. Have they given you actual closing and opening balances? No. Now what to do? Apply your brain. They have given you the movement. They have given you the movement. Come on, see the movement. They've given you the increase in inventory. They've given you the increase in receivables, increase in payables. So now you need to ascertain how the movement is affected because of acquisition of a subsidiary. How is the movement getting affected because of acquisition of a subsidiary during the year? That's the question. So what will I do? Come on the board. Basic maths. I am explaining this in detail to you, the concept. Please pay very kind and attentive mind to this. How do you calculate the movement? What is the formula of movement? Closing balance minus closing inventory minus opening inventory is the movement. Am I correct? Am I correct? Closing minus opening is the movement. We all relate with this. Now, since you have acquired a subsidiary during the year, so you are supposed to adjust your opening inventory. You are supposed to add something to the opening. You are supposed to add something to the opening. So what will your formula become? Closing minus opening plus subsidiaries inventory. Now, if I add something here, when I will open this bracket, actually I'm deducting it. When you will open this bracket, I'm actually deducting it. So on the right hand side also, I'm supposed to deduct something from the movement. Because how can you make an equation balance? How do you make an equation balance? Basic maths. Add 2 to both LHS and RHS. Deduct 5 from both LHS and RHS. So if I deducted something, if I added something to my opening here, it is getting the effect on the movement is that my movement is reducing. If I add something to my opening balance, my movement reduces. Are you understanding this point? Come on, once again. Let's take hypothetical figures. Let's take hypothetical figures. If my closing balance was 2 lakh and my opening balance of the inventory was 1,50,000. Okay. Closing was 2 lakh. Opening was 1,50,000. So I am supposed to calculate my closing minus opening. But subsidiaries inventory is given to us as $10,000. Let's assume a situation. I'm assuming this. This is the hypothetical situation. So what you will do? You'll say, ma'am, closing minus opening is the movement. So if I apply this formula, what I get is 2 lakh minus 1,50,000. What is the movement? What is the movement? Yes, 50,000 is the movement. Now change your opening balance. Change your opening balance. You need to add something to the opening. So it will be 2 lakh minus 1,50,000 plus 10. Forget about RHS for now. So how much it would be? It will be 2 lakh minus 1,60,000. What is the movement now? What is the movement? 40,000 is the movement. Did the movement decrease? Movement decreased? That's what I was explaining you with the help of an equation. So if anybody asks you, and you are sleeping, and if somebody asks you what happens when you acquire a subsidiary to the movement, you say when I acquire a subsidiary during the year, my movement reduces. If I dispose a subsidiary during the year, what will happen? If I dispose a subsidiary during the year, what will happen to the movement? Vice versa. Let's figure it out. If I dispose a subsidiary during the year, my formula is closing minus opening is equal to a movement. So when I dispose a subsidiary, it is closing minus from opening, I need to reduce that amount. X is that amount. That means I am adding something to my LHS. I am adding, this is left hand side of my equation. I am adding something. So that means to the movement also I am supposed to add X. So this is the crux of the concept that whenever you acquire a subsidiary, your movement decreases. Whenever you dispose a subsidiary during your year, the movement increases. Write it somewhere so that in the exam you don't have to build these equations. This is just for your explanation. So come on, write it somewhere. Whenever there is acquisition of a subsidiary during the year, the movement reduces, the movement decreases. Yes. And whenever there is a disposal of a subsidiary during the year, the movement increases. Clear to all? Come on, quickly. YouTube family, Zoom people, clear to all? Crystal clear? Movement, closing minus opening is movement. Are we all clear? Yes. Awesome. Okay, let's move on. So what will be my impact here? So here there is an increase in inventory. Movement is 6,58,000. With the acquisition of Trugis company, what should be the impact on the movement? Movement should decrease. If I want to decrease 6,58,000, should I add something to it or should I deduct something from it? It's a minus 658. If I want to reduce this minus 658, should I add something to it or deduct? Very good. Smart people. I need to add. It's a minus 6,58,000. If I need to reduce this movement, I need to add something to it. So what will I add? I will add subsidiaries inventory. What is my subsidiaries inventory in the question? Let us see. Subsidiaries inventory is 2,56,800. So let us write it there. So I will add 256,800. So what is the proof that is the movement actually decreasing? Let's see. Let's do the total. So they are saying actual movement is this. When I add this to it, is it decreasing? Yes. I brought down 6,58,100 to 4,100 and 300. 1,300. So that was my objective. I wanted to decrease the movement. It was given to me as a negative amount. I added something to it. It decreased. Yes. Then next, increase in trade receivables. It's once again a negative amount. If I want to reduce it, what should I do? Add or deduct? Very good. I need to add. What is my subsidiaries receivables? 2,20,300. So 2,20,300. Let's just add it over here. 2,20,300. Let us see, is the movement reducing? Is the magic happening? What we wanted to do? Yes, the movement reduced to 8,800 only. From 2,11,500, it reduced to 8,800. Then 93,900 positive. If I want to reduce this movement, add to it, deduct to it. Very good. Deduct. How much should I deduct? What is the payable? Payable is given to me as 1 movement. Is my movement reducing? 93,900 minus this 81,500. From 93,900, I brought the movement down to 81,500. This is how you make sure that you are correctly accounting for it, and this is the subtotal column. And we have practically done everything from the pre-populated spreadsheet. If you want to do the totals, you can even do the totals. So you've included everything over here. You've completely dealt with this. This gives you 14 marks in total. You're supposed to, adjust. At least even if your calculation is going wrong, if your addition or subtraction is going wrong, it's totally fine. You have to make the adjustment. Just posting the adjustment gives you half a mark. Even if I write 1, 2, 3, 4 here, and I am adjusting trade receivables, that means trade receivables were to be adjusted. You just calculated it wrong, I still give you half a mark. So how many places have I adjusted? 1, 2, 3, 4, 5, 6. I've adjusted 6 places. If I would just write imaginary figures here, plus minus, forget about it. But if I write it in the correct column or the correct row, if I know property, plant and equipment needs to be adjusted, if I know that tax needs to be adjusted, I get 3 marks. 6 places, half mark each. So the people who tend to just leave a pre-populated spreadsheet, okay, this is what you are losing. Please don't get panicked or hyper during the exam. Make sure you manage it well, and you will be able to do it if you apply your common sense. So we are done with this question. Let's do the explanation part. What we were doing, we've already given 4 points. While solving, we became sentimental and we forgot to explain. So 5 points, 5th point here, I can write about taxation. Yes, for taxation, I can write about current tax, a separate point. Then for deferred tax, I can write a separate point. I'm not going to explain it. When I was doing the calculations, I've verbally explained it to you. So for that, you can articulate one sentence, right? Then you'll talk about PPE, that how depreciation and how we calculated that actual cash outflow because of acquisition of PPE. Then you can explain your working capital movement, whatever I explained to you, the working capital part, you can just write that if we acquire a subsidiary during the year, we decrease the movement, decrease the movement, and if we dispose something during the year, if we dispose a subsidiary during the year, we increase the movement. Yes. So all these points of adjustments you could have explained. Right? So that's how you were supposed to deal with this question. And then they are saying, using Exhibit 2, advise the financial controller as to how the various financial instruments, including overdraft, should be presented in statement of cash flow. So what are they talking about? Financial instruments, small exhibit. Let us see together. What financial instruments are there? Cavallo Group has a number of financial instruments presented within its financial position, right? Some group entities which had surplus cash resources had acquired debentures in other non-group entities to increase returns. So we have surplus cash resources and we have acquired debentures. When you buy debentures, it's an investment. Am I right or am I right? It's an investment. Yes. So whatever you pay to acquire debentures should go as a cash outflow in investing activities. That's your first point. Then what do you have? Non-group entities. Other group entities had raised finance by issuing bonds. So if you raise finance by issuing bonds, which activity? Money is coming in, it's an inflow. Which activity? Yes, financing activity. Very good. It's a financing activity. Sorry if I missed a message on chat box. Faith, I request you to go to YouTube live, it's like you can, rewatch the thing. Whatever I've said, you can rewatch it on my YouTube live. It's currently there on the live session. You can move out of the Zoom session and you can go and watch it on YouTube live and get your doubt cleared. Right? Okay. So what I have is other group entities had raised finance, which will be financing activity. Then Cabello Company financed the acquisition of Trudis by acquiring a bank loan. So what is this bank loan? Financial liability. So that means, once again, this is cash inflow. Which activity? Which activity is this? Awesome. Financing activity. Then Cabello had overdrawn bank balance as at 31st December 2015. That means overdraft. So how do you treat overdraft? What is overdraft? Yes. Cash and cash equivalent. So my overdraft is treated as a cash and cash equivalent. It's a negative cash balance. So I have 1, 2, 3, 4 direct points. I need 2 more points. How can I pass time with this question to get those 2 extra marks? First of all, I can explain that issuing bonds is a financial liability. So you can give a little definition of financial liability. Then when you talk about this overdraft, they are giving you another bonus point that the overdraft fluctuates regularly from an in-funds balance to an overdrawn balance. What does this line mean? Can you decode this? This is a little bouncer kind of a line. Can you decode this for me? I'm not understanding. What are they trying to say? What are they saying? Yes. Okay, one student says convertible loan. Overdrawn bank balance fluctuates regularly from an in-funds balance to an overdrawn balance. Do you guys have current accounts? Or anyone in your family has current account? They're doing their business. So what happens in current accounts? I am having a positive balance one day. Next day I withdraw more. So now I have a negative balance. So they are saying it keeps on fluctuating. Yes. Sometimes I'm using more than what is available. Very good, Srishti. So sometimes I'm using more than what is available. That's an overdraft. Sometimes I make things available with my in-house balance. So what I can write with regards to this line. So I'm not supposed to brainstorm a lot. I just need one extra point. So I will just say it's a very fluctuative balance. So we need to see at the reporting date whether it's a positive balance or a negative balance. If it is positive, then it will be a positive cash and cash equivalent. If it is still overdraft, then it will be a negative cash balance. Are we guys clear on this? So I can just say that this is a fluctuating thing. I need to figure it out at the reporting date. What is its situation, current situation? Awesome. So we are done with our question number 1. I've discussed this with you. I hope you guys can frame 6 points out of this. 1 for debentures, 1 for bonds, another for bank loan, 1 for overdraft, lastly for this overdraft fluctuation point, and 1 time pass point I can pick up and explain financial liability. Sorted. Let's move on. We are done with question number 1. Next question. Question number 2, ethics and operating segments. So let us see what's there. We have 100 people watching us on YouTube also. Silent people, don't speak up. Okay. What do we have here? Operating segments. Before that, requirement. Copy the requirement into your response option. So what is given to me? Let's copy it in the word processor as it is. Let's quickly format this. Professional marks will be awarded. Okay, then we have part B. Then, okay. What do we have here? So first, exhibit 1, discuss ethical issues caused by the current business situations for 10 marks. And then 2 marks are available for professionalism. So I'll write this out for you so that you guys understand how to get your professional marks. Then explain in accordance with IFRS 8. What are they asking? Your explanation should cover whether division A, B, C, D should be treated as separate reportable segment. And they've even given you headings. They said first explain operating segment, then tell us what is aggregation of operating segment. That means you add up these segments, then identify the reportable segment. Very easy direct question. Literally very easy question. You all know what is an operating segment. I'll write it for you anyways. So let's start the reading. Let us start the reading of this. What do we have? Ethical considerations first. Okay. So my ethical considerations. The finance director of Dario company is not a permanent employee but is paid on a consultancy basis. Oh. Is it a threat in itself? If the finance director is working on consultancy basis, first of all, will he be interested in your work? See, what he would be interested is his fees. His fees is based upon how much consultancy you take from him. So he will try to make sure that you stick around, right? So you kind of get indulged. If you, let's suppose, you go to a consultant, his task is that you stick around with him unless he's a very ethical person. So he will keep you, looping around the things so that you always need his consultancy in that situation. So that's a self-interest threat because he just is on a 6-month contract with us. Also, since he is on a 6-month contract, can it be also called as a assumed pressures, intimidation threat? Because at all times he is going to be, like I will be removed from this company. I need to make sure that I'm working right. Otherwise they'll remove me. Maybe he's too much dependent on the fees that he's getting. So what I can write as my first point is in my ethics about independence. I can write about independence of finance director. Then I can talk about his self-interest. And then I will talk about his intimidation threat. So see, it's all about your exaggeration. From one line, we figured out 3 things. We'll explain this. We are just identifying here. Then they're saying the CEO is a personal friend of FD and she recommended him to the board of Dario. So this is like they are chilling around. The CEO and the finance director are like friends and this is leading to familiarity threat. So FD and CEO both are ACCA members. So both of them are bound by ACCA code of ethics. This is a point that you will mention. The things that you understand in your mind are the things that you have to write in your answer to get that 1 mark per relevant point. Then Dario company currently has a cash flow problem. See, here I can't go by just reading one line, I frame answer because it has to be in a logical flow. It has to be a professional answer. It is not bullet point, it's a paragraph. So I will have to read the whole thing. I can brainstorm together while reading the answer and then I'll frame my final answer. So Dario currently has a cash flow problem. Okay, Dario is the company. And the CEO has asked the finance director if he is prepared to reduce his current fee by 50%. What do you think is this? Is it a kind of a threat? No, this is not a threat. CEO has asked the finance director if he is prepared to reduce his current fee by 50%. Now, this means that he might deteriorate the quality. So, come on, in your points of identification, you've identified familiarity threat, right? And then reduction of fees might deteriorate quality of service, because whenever you lowball, you must have seen many people, they are giving things at a very low price or anything. Why such mentality is there? Why do you guys buy iPhone? Why do you go to Apple store? Why do you go to those, you consider those brands as brands? Because they are charging you for this, because you believe there's a mentality that more the money is charged, better is the quality, right? So this means if this finance director is going to work at a very less fee, 50% is a huge slash. So if he's going to work at a very less fee, what about the quality of his work? That might deteriorate as well. That's why when you do audit exam, you'll understand that low balling is an unethical practice, right? Where is intimidation threat? Intimidation threat I just covered with you, that when we said there's a 6-month temporary contract, so you are always intimidated that what if this company lays me off? What if this company removes me? That's why intimidation. Assumed pressure. Then the finance director's contract is due for renewal in the next month. Add this to intimidation. Renewal is in next month, so he doesn't want to offend the company because his promotion, his renewal is around the corner. The CEO has recently spoken to the FD and stated that his contract is more likely to be renewed if he is prepared to take reduction, intimidation. Once again, so they are saying we will only renew your contract if you reduce your fees. Once again, that's an intimidation, right? Then she has also said that if he needs support, then as a friend, she will help him. So if he needs support, she will help him. That is addition to familiarity, which we identified. Then the finance director is upset by the fees request as the no other director has taken a cut in their salary. So he's like, why are you reducing my salary just because I'm a consultant? And you're not reducing other people's salary because they're full-time. The students who are saying, why is it intimidation? Guys, if you are under a temporary contract, you are always, a sword is hanging on your head. You might be removed anytime. Whereas who is a permanent employee, they are quite secure. It's known as job security. So this finance director is not having a job security. He wants renewal of his contract, but he knows that his contract is temporary. It's just for 6 months. So he wants renewal. Right? 10. He is currently undertaking a going concern review. So imagine a situation, this finance director is doing going concern review for the Dario company. And all this is happening, but has decided not to complete his report until he has considered his position with Dario. So now he's like, go to hell everyone. I'm not going to do this going concern thing, right? This is my self-interest. He's putting his interest forward and he's like, if you do not give me a clarity, if I'm working with you or not, why should I do this work? You're not sure whether I'll carry on this contract with you. So I'm not going to, work on this. So he's compromising his objectivity here and also he's compromising his work quality here. So I refer to a point of quality of work, right? So that's in addition to that quality of work point. Then finance, yes, professional behavior can also be mentioned over here. Then the finance director's findings will also form part of a submission to the government for funding and will be shared with external auditor. So it's a very important task which he is doing. And he knows that the current cash flow position would indicate that the company is not a going concern and that if he submitted his report, there would be no government funding. So this finance director knows that if I do this review, I will give a conclusion that this company is not a going concern. They have a bad cash flow position. And there is also the possibility, see, in this situation also this guy just needs his salary. So this company is totally bankrupted kind of a thing, not having going concern, but this person just needs his salary, which is okay, that's his self-interest. Now there is also possibility that the financial statements would receive a qualified audit report. That means there are misstatements. He is considering overstating the future potential return on investments. What is this? What is he doing? Overstatement, misstatement. Misstatement means no professional competence, no professional behavior, compromising on integrity and objectivity. Then in addition, many of the accounting staff are remote employees, meaning that they are now working at home rather than working in the office. Oh, thank you for explaining what you mean by remote employees. The finance director is worried about the possibility of data theft. Now, this another point relates to IT. He's concerned about data theft. The people who are working from home, that's where the data theft risk increases because you're not using company's system, company's hardware. So unfortunately, he does not have skills, does have Dario company have the capacity to undertake a widespread investigation into the issue. So given the current request to reduce his fee and cash flow situation, he also does not give the incentive to deal with the potential data theft. Is this a correct thing? He does not want to deal with the data theft or inform the board to enable them to address this problem. What he is doing here? Not competent. Have you guys done that video where I talked about ethics of an accountant in the digital age? So when you work in a sector, so let's suppose you are in the teaching industry and you do not know how to operate a computer. So that is something that you should get trained on, right? If you're teaching online. So similarly, if this finance director is working and this finance director is working for Dario company where data theft is an issue, where IT is used, why in the world is he not aware about that IT? He needs to get training. A. B. Due to his self-interest, he's ready to deteriorate the quality of his work and he's like, okay, I don't want to get into the investigation of this data theft. That is also still acceptable. If you want to leave the position, you might not deal with the investigation, but at least inform the board that they can at least cater to this. So he's not even doing that. Completely unethical. No professional behavior. Useless. Bash him. So however, he has asked the information technology department to add productivity monitoring software to all remote employees without their permission or knowledge, and any employee who spends time on non-business websites will be immediately disciplined. Is this a correct thing to do? I'm sure this is happening with many of the employees in reality, but is this a correct thing or ethical thing to do? Isn't it breach of privacy of that employee? This is something you can sue that person for. This is unethical. How can you breach the privacy of any employee? How can you put that software or something? See, they might be doing anything in the non-business website when they're not working. So this is something that you are not doing correct. It's very unethical. So we'll talk about this also. So now we've understood the case, right? And now we can make as many points as possible. And since it carries professional marks, so we will, keep it a little professional. Okay. Iqbal, he's saying companies, property, and business working hours. Everyone does this. Why is it unethical? Because they are saying it's not company's property. They are going to introduce this software in the employee's personal hardware because he's working remotely. So that is not good. If you are doing it in your own hardware, that's fine. The employee is supposed to use that laptop just for business purposes. If he's using for other purposes, then it's wrong on employee's part. But the employer is not supposed to introduce any such thing for the hardware of the employee. Okay. Now let us write this answer. First, independence of finance director. So what I will write? The finance director is not a permanent employee of Dario company and is rather working on a temporary contract of 6 months, which is due for renewal in the next month. This is just background that I've given. In the given case, in the given situation, it is essential that being a consultant, the finance director should have some independence. That means he should not be financially dependent on Dario because of the high fees he might be receiving from Dario. So usually in audit, we say there's a criteria of 15% for auditors. That if your fees that you're charging from the client is 15% of your total revenue for 2 consecutive years, we say it's a high fees. So over here, there is no such criteria, but we are trying to say that he should have some independence, right? So what is the risk here? Like, why we can't be dependent on the fees? If the FD is highly dependent on the fees from Dario, then due to his self-interest, he might be too accepting towards Dario's demands because he does not want to lose an important client. Thereby compromising his objectivity and integrity. So I can go on and on to explain this point only, but I'll stop because I have to write other points also. Self-interest. What is the self-interest threat here? Where was the self-interest? Yes. Where was the self-interest? This was self-interest only. What is the self-interest point over here? We'll say the temporary nature of the contract, the temporary nature of the contract, the temporary nature of the contract in itself will create a self-interest threat where at all times the FD would only be interested in his consultation fee, and will keep his financial interest over the Dario company's interest, right? Then you can even explain the situation further over here, that where they are asking them to self-interest, we'll even relate, we'll move ahead in the case study, we'll say, also, we'll write it here, also the FD when requested to reduce his fee by 50% became double-minded about the continuation of his service to Dario, and under his self-interest, he even started deteriorating the quality of his work. So it's just like he's on notice now. Quality of work. You can explain how he started quality of work. The FD was hesitant to conduct going concern review, right? He was hesitant to conduct going concern review. What else was he doing? He decided not to complete his report until he's clear about his condition. And then he also said, okay, fine. So what I'll say, the FD was hesitant to conduct going concern review, which he knew was very important for Dario to achieve government funding, right? And we can even further say such a what he's doing here, he's running from his responsibility. So such a compromise on quality of work is also against the professional behavior as he is an ACCA member and is bound by code of ethics. Then intimidation threat. What can I write about intimidation threat over here? Come on, what can I write about intimidation threat here? I'll simply say the temporary nature of contract and renewal of contract around the corner, especially when the CEO has made it very clear that they will renew the contract only only if the FD reduces the fee. This statement comes as if there is no option for FD to say no to the reduction of fees. This leads to an exerted undue pressure on the FD to continue the work with reduced fee, with no scope of bargain/negotiation. They're like, either you reduce your fee or we will not renew your contract. That is a kind of pressure that you're building, right? That's an intimidation threat. So this assumed pressure might compromise FD's integrity and objectivity, and is one of the major reasons why he is not cooperative with Dario in the given situation. This assumed pressure might compromise FT's integrity and objectivity, and is actually one of the major reasons why he's not cooperative with Dario company in the given situation. So if you are intimidating anyone, why do you expect from that person that he would be acting in your interest, right? You're telling him either you have to be with us. If you would want to renew your contract, you need to reduce your fee. So you are intimidating them. You're like, even though you're friends, but still you're intimidating them. So how can you expect them to be working in your interest? So they would lose interest. So that's what has happened to FD here. Then familiarity threat. What is the familiarity threat over here? The CEO and the FD are both friends and share a long personal association, not relation. Let's use a professional word. Long personal association, which might lead to compromise of objectivity, as the FD might become too accepting of the work of CEO. And also, not just this, or also means that only, also the FD might assume a pressure due to this friendship, where considering the cost benefit, he wants to quit the contract. But would still continue just for the association, just for the familiarity, and in real might compromise on quality of work. So how is quality of work affected over here? First of all, the quality of work is affected, professional competence is affected when he's considering to overstate the future potential return on investments. You can write this point over here only. The FD, what he is planning? He's planning to overstate future potential returns. The FD is planning to overstate future potential returns, which will lead to manipulation of accounts and and a strong, or you can say a brutal compromise on his integrity and objectivity due to familiarity with CEO and his self-interest threat. Right? This is something we've written with regards to familiarity only. Yes. Then reduction of fees might deteriorate the quality. So that's what we've written already. Now let's make a last paragraph on that data theft point. Data theft. In the digital era, if an accountant is working with technology, he should completely understand the threats of the technology usage. This frames part of his professional competence and due care. The FD in this situation does understand the data theft risk with remote employees, but is still not sure of what should be done as a safeguard to this. The FD should get a training on the softwares his clients are using to protect them from any data theft. The FD even is not keen to take measures because he is not sure of his position at Dario company, which shows lack of professional behavior. His future with Dario should not affect his current performance at Dario when he is under contract. Right? And then above this, the FD is not even ready to let the board be aware, about this issue so that they can take steps from their end. This again suggests compromise on professional behavior, integrity, objectivity, and competence. Not competence, due care. You should be careful towards your client, and if you're not being careful, that's against your competence and due care. So this is what we can actually write for our ethics point, and then you can give a small conclusion to this point, that the mistake is not just the FD's mistake, it's the mistake from the CEO also. She is also ACCA qualified and she's intimidating the FD. She's not maintaining good relations and she's kind of taking benefits from the finance director and still not giving clarity that whether they want to continue with the same finance director or not. And they're also getting wrong works done like overstatement and stuff to get government funding, so which is also unethical. So you can give that type of small conclusion, like a 2-sentence conclusion. So all of this thing frames our 10 marks ethics question. Are you guys clear on this? Like, do you get a clarity how your presentation should be? Your content can be different. There's nothing black and white here. It's all gray. Whatever you think is right, you can write that. There's no such pressure on you that you have to write it in this way only. Do we all understand? Yes. Are we clear? Clear to all? Awesome. Okay. Now operating segment. Come on. What do you have as an operating segment? They've asked you the definition of operating segment over here. So you should give a definition of operating segment. What is an operating segment? Which has operating segment, I'm writing in short form. Anyway, this does not carry professional marks, so you can write in as short form as possible. So what is operating segment? Which has a major, you can say, a major division of the entity which has its discrete financial information available, which is used by chief operating decision maker, that is chief CODM, which is used by CODM while making major decisions. So usually such divisions are operating segments who have discrete financial information available, A. B, their information is being used, right? Their information is being used, what? Their information is being used by the CODM. So A, their discrete information is available. B, they are being used about the CODM. Then aggregation of the operating segments. For that, let's read the exhibit. Dario has 4 division A, B, C, D. Okay. Division A and B produce and sell to third parties. So that's the work of division A and B. Division A produces vaccine and sells them to governments, generating 60% of Dario's total revenue. So that's division A. 60% of total revenue. Just I'm highlighting this with green. This is helping me in identification. Right? Then division B produces allergy testing kits and sells them to pharmacy wholesalers, generating 20% of Dario's total revenue. This will also help you in identification whether it is an operating segment or not? Division B's long-term average gross profit margin is significantly higher than Division A. What do you think? Are these Division A and B seemingly operating segments? What are the rules of identifying operating segments? Come on, let's write the rules of identifying operating segments. IFRS 8. Let's mention IFRS 8 gives the following threshold to decide which segment is operating, and which is not. So first rule is rule number 1. If the segments external and internal revenue, combined external and internal revenue is 10% or greater than entity's total revenue. That is revenue test. What do you have as profit test? Come on, profit test. If the segments absolute means when you don't consider whether it's a profit or a loss, absolute amount of profit or loss is 10% or higher is 10% or greater than the higher of two amounts. Which two amounts are you supposed to consider? You have to take higher of two amounts, which I'm going to list down. A, total profit made by profitable segments. B, total loss made by loss-making segments. So if you have 5 divisions and 3 of them are making losses and 2 of them are making profit, so you will say what was the total profit amount? Let's suppose it was 10,000. Total loss amount was 8,000. So what is your threshold? Your threshold is 10,000 or 8,000? What is your threshold? 10,000, because I have to take higher of two amounts, right? So I'll take higher of the two amounts and I will see if that particular segment's profit or loss is 10% or greater than the higher amount of these. Clear? Then what do we have? Third test. Come on. What is the third test? Total asset test. What is the total asset test? Yes. What's the total asset test? If the segments assets are 10% or greater than the combined asset of the entity. Awesome. So these are the 3 rules which we have to follow while determining whether our segment is a reportable segment or not. Correct? Now, what is aggregation of operating segments? When do you aggregate operating segments? If that 75% rule is not met. So if you do not see 75% rule being met, what do? You pick up more segments and you report them. Or you might combine 2 segments and they become one operating segment. So what is this 75% test? Can you mention that 75% test to me? Yes, what is the 75% test? 75% revenue test. Yes. We'll write in our own words. What is it? If all reportable segments combined external revenue is not coming out to be at least 75% of 75% of entities revenue, entities combined revenue, then the next best segment is chosen as reportable operating segment. Reportable operating segment. Clear? So this is the 75% test which we do. So we have just stated the rules. How many marks are we getting for this rule? We are getting 4 marks for these rules. Each rule is giving us 1 mark. Now, how many marks have I got here with the definition? 1 mark with the definition. So 5 marks are already mine. What is the mark allocation of this question? It is for 8 marks. So out of 8, 5 marks I've already gathered. If you do not know about this aggregation, you can even leave that. Right now, you still have the identification left with you. So related to the case study, come on. Let's do case study. As per the case study, what's there? Which segment is operating segment? So we can write division A and B are operating segments because the revenue test is met in division A. In division B also revenue test is met. When I talk about division C and D, undertake research and development. Division C does not provide any research and development services to third parties. Okay. And only conduct activities for division A and B. So is this division even having external revenue? Is division C and D even an operating segment? It does not meet the definition of operating segment. Yes. So let's talk about this. Let's talk about this. That the operating segment is where external revenue is generated. In division C and D, there is no external sales, and rather it is just a cost center, which helps division A and B. Division A and B. Yes. So division C and D are not operating segments. Next, we can write here as per the case study, division A and B meets the revenue test and have great level of external revenue, therefore are clearly operating segments. Next, what else is given to us? Division D performs contract investigation activities for other laboratories in pharmaceutical companies. The external revenue present 20% of total revenue. Division D, okay, division C is not an operating segment because it is not making external revenue. Division D is making it. So let's just, okay, we have just written division C only. For division D, what do you think about division D? Is it an operating segment? Division D? Is division D an operating segment? Is the 10% rule met? Yes. So division D is also operating segment. Then operating results of A, B and D are regularly reviewed by the CEO. These results have separate disclosures. And there are 4 division heads who are directly accountable to the CEO, and these heads regularly discuss the operating activities, blah, blah, blah. So I don't need all those points. So I will just say division A, B, and D. They are operating segments. C is not a segment. Now, when they talk about aggregation of operating segments, what they want to talk about here? Aggregation means, by aggregation, see, we can pass the time if we don't know the rule. By aggregation, it is meant that 2 segments together are combined and separately disclosed as operating segment. Now, when you combine something, when you make people need matchmaking, you need to see whether the nature matches, or will you combine 2 opposite divisions. If one division is into selling internet services, another division is selling into pharmaceutical products. Can you combine these two? So what is the general rule of aggregation? The general rule of aggregation is that only 2 such divisions can be aggregated whose nature of business, nature of products and services sold, nature of customers, location, etc. are similar. And you can even close your question here because you're getting more than 8 marks. If you don't have time, you can simply close your question here, or you can further explain in this case study. What do you think? If you talk about division A and B, division A is producing vaccines, selling them to government. Division B is producing allergy testing kits to wholesalers. Are they similar? The customers of division B are wholesalers. The customer of division A is government. Do you think they are similar? Even though they both are doing pharmaceutical business, are they still similar? What do you think? Can I say they are similar? No. So I cannot aggregate them. So you can give a quick example over here. Let's give a quick example. We will say, for example, division A is selling pharmaceutical products to the government, whereas division B is selling the allergy kits to the wholesalers. So first of all, their products and customer base are not similar. Therefore, they cannot be aggregated. So the major portion of my answer, which was giving me my major marks, were just related to plain explanation of IFRS 8. What do I mean by operating segment? And then just closing my answer with the identification. Are we guys clear on this? Come on quickly. Are we all clear on this? Yes. Let's move on to the next question. Question number 3. Yesterday we did part of question number 3. Do we remember this requirement? Now I will just discuss this with you, brainstorm with you. I'll not type the answers. So if you want, you can even write whatever I tell you verbally or I write on the board. So in here I have three requirements. What are these three requirements? First, they are saying explain how to account for credit impaired loans. So when you take credit impairment loans, like credit impaired loans means you have taken the loan or you have given loan. So credit impaired means you have given loan. That's why it is impaired. So you have purchased in credit impaired asset. When you buy in credit impaired asset, what is the rule? Whenever we buy any credit impaired asset, what are the rules? Come on. When you buy credit impaired asset, what are the rules? What are the rules when I buy credit impaired asset? Number one, initially the treatment is same, that you need to record them at their fair value plus the transaction cost. And then secondly, when subsequently I'm supposed to do that calculation of opening asset plus interest minus the cash received is equal to closing asset. Then in that case, I will use interest, which is credit impairment adjusted rate, which is given to me in the question always. CIAR. I need to use credit impairment adjusted rate. What is credit impairment? You all know IFRS 9. So in IFRS 9, you have a proper section of loss allowances. Yes, you have a proper section of loss allowances. So these are expected loss allowances which you create when you have a doubt, when the credit risk increases. Either you create 12-month expected loss allowance or you create lifetime expected loss allowance. But in this case, since we have taken already impaired asset. What do I mean by already impaired asset? When I purchased this asset, that means when I gave loan to someone, I knew this person won't repay. That person himself told me that I will not repay you. So maybe what's the practical situation? Why would you give loan to such a person? Practical situation. There was a debenture issued by company A in 2020. Now this debenture is floating in the market. We all know this. This debenture is floating in the market where we can invest. So we can buy this debenture from any person. So when you get shares in IPOs, you are the first holder of that share and then you sell it to the secondary market participant. So similarly, the person who initially bought the debenture, they bought it at full amount. But let's suppose in 2021, company A declared that they will only repay 60% of their loan because they were going through some, let's suppose they were going through some kind of difficulties and they said that we will just repay 60% of the loan. Company A said in 2021. So what is the timeline? 2020, the debenture was issued, right? This person bought this debenture at full amount. Now he has the debenture and he wants to sell it in the market. Which market is this? This market is stock market. You can buy, you have debts also, you have bonds floating in the market also. So now he wants to sell it in the market. Now in 2021, this company A says, I'm not going to repay 40% of the amount. I'll just repay 60%. Now, if any person buys this debenture from this person who bought it initially, this new market participant will buy that debenture from this original buyer of the debenture at credit impaired asset because it was issued in 2020. He is the original buyer, but by 2021, this debenture is already impaired. So in 2021, if anybody buys this asset, he will be told that he is buying a credit impaired asset. So the mother of that market participant will tell him, why did you buy this asset? Don't you know that this company is not going to pay? He'll say, no, I'll buy it at a reduced price, because of course, if company has said I'm not going to repay, the fair value would have decreased. The market takes the information like fire. If today any company says I'm not going to repay, it is going to spread like a fire. So the fair value of the debenture must have decreased. So this new market participant has purchased the debenture from original buyer at a reduced price. And maybe in future, he thinks that this will improve and he will sell it at a higher price. So he's betting only, he's speculating only, his sweet will. And in this question, you will practically see that the situation is improving. So this is credit impaired asset. So when you buy an already impaired asset, we say first initially recorded at the price you purchased it, that's a reduced price. And then when you are subsequently, calculating the interest part, you all know financial assets, debt instruments. How do you deal with it? Opening asset plus interest minus cash received is equal to closing asset. So usually you take effective rate of interest there. But in this case, you will use a new rate, which is CIAR, credit impairment adjusted rate. Right? Now come on, let's see this question. What's given to us? Loan portfolio. Let's read it. You will better understand while reading the question. So this company purchase credit impaired loans and measures these at amortized cost. So that's their hobby. They purchase such assets which are already credit impaired. So Jantica company correctly calculates the loss allowance as the changes in lifetime expected credit losses since the initial recognition of the asset, which is effectively the change in estimated cash flow. How do you calculate the loss allowance in case of credit impairment? All of my students, we did this in the IFRS 9 live class. Come on, tell me, how do you calculate? It's a very in-depth concept. Not everyone would know this. How do you calculate loss allowance in case of credit impairment? Because loss allowance in general is calculated as, let me write this answer for you. It's a little technical. Let's write our answer over here to loan portfolio point. What are we going to say? We'll write it in bullet points. First of all, the company has purchased credit impaired asset, which is initially recorded at reduced price. That means the purchase price, but whatever price you purchased it, right? Plus the transaction cost, capitalize the transaction cost. Subsequently, the what is there? Subsequently, the interest income on such financial assets are calculated at using CIAR, which is credit impairment adjusted rate. This rate is usually lower than the effective rate of interest, because of course, if an asset is impaired, it will give less return. So it's a smaller rate. Then what will I write? Yes. What next? We will say the loss allowance on credit impaired asset is usually calculated as difference between the present value of cash flows, or you can say difference between the gross carrying amount. So all my students, you've done this with me. Let me show you in your notes. The people who've been attending my classes, we did this in our live class. Remember this part of your notes? I told you retain to your memory. There is a reason I always tell things. I just don't babble around. See, this question is asked. Expected losses on credit impaired assets are calculated as difference between assets gross carrying amount and the present value of future cash flows discounted using original effective rate of interest. As it is, I'm supposed to copy this. So what will I write? The loss allowance on credit impaired asset is usually calculated as difference between the gross carrying amount. Gross means without considering any loss allowance. Gross carrying amount and the, what was the line? Present value of expected future cash flow discounted using original effective rate of interest. Present value of future expected cash flow discounted at original effective rate of interest, right? Effective interest rate. So this is what I use. So what I will do, I'll figure out these amounts from the question, see what they've given. On 1st January, J company bought credit impaired loan with the remaining term of 4 years and it paid 32 million. So initially you've recorded it at 32 million because that's what you paid to acquire this, right? Then at 1st January, the remaining contractual cash flow expected to be received. What are your expectations now? Your expectations on opening date are these. That means for the next few years, you will just receive this much. Your CIAR is given to you as 3.9%. Okay. Now, during the year, 8.8 million was collected and on 31st December, that means at the reporting date, credit worthiness has improved. So what is your revised estimate now? Now you think for the next 3 years, you are going to receive this much. So what you will do? You will simply look at the board now. You'll simply calculate two present values. First, you will calculate the gross carrying amount. So first you are going to calculate the gross carrying amount. How will you do that? Let's do it together. Everyone, please calculators out. I will be asking you and you will tell me whatever is calculated on board. So what I'll do? First, I'll think about simply that what is my loss allowance, how to calculate for 3 years. That means 31st December 2007, 31st December 2008, and then 31st December 2009. Why 3 years? Because I am standing on 31st December 2006. So what was the accounting treatment on 1st January 2006? That is also a question. So the day you purchased this loan note, the day you purchased this debenture, what was your journal entry? For how much did you purchase this loan note for? What was the amount that you guys paid? Come on. From the question, what was the amount that we've paid to acquire them? 32 million. So my first journal entry, because in the requirement they have stated, please give us journal entries. So you will say my loan asset debit, that means my debenture debit and my cash credit by 32 million. Yes. Then secondly, when I was dealing with it from 1st January till 31st December, how do you treat your debentures as? These are your financial assets, debt instruments. So you deal them under IFRS 9. What are the methods available? Amortized cost is available. Fair value through P&L is available. Fair value through OCI is available. If nothing is given, what do you choose out of these three? What is by default? If nothing is given, what do you choose? Debt instrument. This is not equity. Amortized cost. And if you check the question, they are thinking about their expectation till the last date, till the date of maturity. That's why they've given you expected cash flows. So you will say, I'll keep it under amortized cost method. So what I'll do, I'll calculate my amortized cost. I have opening asset plus interest minus cash received is equal to closing asset. So I'll say my opening is 32 million. My interest to be used is 3.9%. Can you tell me what is 3.9% of 32? 3.9% of 32. Come on. What is that? 3.9% of 32. 1.25. Very good. So 1.25. How much cash have you received as per the question? How much cash have you received? They've said you received 8.8 million. It's written in the question. So what is your closing asset? What's my closing asset? Yes. Very good. 24.45. So what is my journal entry to this? What is my journal entry to this? I will say now at the reporting date, my journal entries. Initial journal entry have already passed. For this interest, this will go into P&L as income. So I will say my loan asset debit by this amount, my interest income credit by this amount. How much? 1.25, correct? And then you're paying cash. What is the journal entry for payment of this cash? What is the journal entry for this payment? You are paying it. So that means cash is getting credited. So cash credit or cash debit, you are receiving it. You are on the receiver side. This is an asset. So your cash is getting debited. Your loan asset gets credited by 8.8 million. Do you understand this much? These journal entries, are you understanding? And by just writing these, you are getting 5 marks. You could have left your question here. You could have left your question here. If you were not willing to calculate the loss allowance, you could have passed the paper by just writing this much. But the complex part of the question now. At the year end, when I'm supposed to calculate my loss allowance, how will I calculate this loss allowance? Everyone, please pay attention. So I will calculate the gross carrying amount first, present value of the gross carrying amount. So if I think about today, what are my expectations? In the beginning of the year, my carrying amount, what were my expectations? How much cash flow was I expecting to receive? I was expecting 8.8 each year. That's what is given to you in the question. Where is it given? Check the question. Let me show you. Where is it given? They said at 1st January, these are your expected cash flows. So that means you would have done all your calculations in accordance to this. So now come to reporting date and calculate your expected cash flow. Take that as base. It's 8.8. So 8.8 here, 8.8 here, 8.8 here. Use the discounting factor 3.9% because that's the only rate given to us in the question. Do the calculation. This, give me the present value. Do the whole calculation. Give me the total present value. Come on. How do you do the calculation? 3.9% is the rate. So you multiply this with 1 plus 1.39. What is it? 1.39. 1 plus the rate. Am I doing it right? Is it 1.39 or 1.039? 1.039 to the power 1. Then here 1 into 1.039 to the power 2 into 1.039 to the power 3. Come on, tell me the total present value. You're getting 8.47 over here. You're getting 8.15 over here. And you're getting 7.85 over here. These are very complex calculations. I already told you, if I was you, if I was passing this paper, I would have just written the entries which I previously wrote and summed it up. So my total present value comes out to be 24.47. 24.47. So this is my gross carrying amount. This is my gross carrying amount. Now I need to compare it with my new expectation. What is my new expectation? There's an improvement which is expected. So what is your new expectation? Year 1, year 2, year 3. Now you're going to receive 10 million, 10 million, 10 million. Same rate, 3.9%. 1 divided by 1.39, 1.039. 1 divided by 1.039 to the power 2. 1 divided by 1.039 to the power 3. What's the present value? What is the present value? 9.62, 9.26. Yes, very good. 8.92. Give me the total. 27.8. Awesome. So 27.8 is my total present value. So what I'm doing is I've currently recorded my asset at 24 point something. What I calculated 24.47. But it should be reported at 27.8. What's the improvement? What's the improvement? The improvement is of 3.33. Very good. So 3.33 is my improvement. What journal entry will I pass for this? What journal entry am I supposed to pass? This is a loss allowance, but this loss allowance is a positive loss allowance. That means you are reducing your loss allowance. So when you reduce your loss allowance, it's a gain. So journal entry is loss allowance debit. Loss allowance debit. Statement of profit and loss credit. 3.33. So all your journal entries, how many journal entries have I passed for this financial instrument? Let's see. How many journal entries have we passed for this financial instrument? 1, when I received it. 2, for the subsequent interest income. 3, for the cash that I received. And 4th one is for the loss allowance. So all of you are supposed to understand these, and let me give you a very honest opinion on this. This is a classic example of a bouncer question, okay? Financial instruments, we all know, is not an easy topic. So you cannot expect a very easy peasy question in the exam from financial instruments. So yes, hedging, if it comes up, then also it becomes such exhaustive. And you are seeing by the time we reach question number 3, we are exhausted. So that means In every question paper, there is a part where you will get stuck. There is a bouncer question. But at that point in time, you have to just write the basics and move on. Just write the basic. Explain credit impairment. Okay, I would have written that. I would have written IFRS 9 rules associated with debt instruments that I keep it under amortized cost. Opening asset plus that general formula I would have given. I would have talked about that CIAR, and I would have talked about the loss allowance, how we calculate it. So out of 8, 4 marks I would have got, and if I was you, I would have been contented. I would not have banged my head over this question. Do you understand the process and the approach? I know this process might offend many people that why ma'am is suggesting to leave things. No, I'm not suggesting you to leave. I'm just telling you the tactful way of dealing with the paper. So in such a situation, if you guys start thinking about perfection, that you are that intellectual mind who will solve this paper, who will complete this IFRS 9, you want to be able to do it, you'll screw the whole paper. You have question number 4 still left. So now quickly, let us see. See, we did part of this question yesterday only. So I'm not going to explain that. This revenue part we did yesterday. I hope all of you remember this, where we talked about the at a point in time over the period of time. And then we talked about that sale and repurchase, IFRS 15. Okay. And this last point from question number 3, this relates to intra-group sales, that to foreign subsidiary. So you will simply write few basic points here, that when we in the individual accounts, how do we treat an foreign sale? So the day you make the sale, you use spot rate. If you have a corresponding receivable, it becomes a monetary item in the individual accounts. For monetary items, which exchange rate do you use? For monetary item, which exchange rate do we use in individual accounts? Closing, very good. So in this question, question number 3, that relates to foreign sale to subsidiary. So first you will tell how it is treated in individual accounts. So you'll simply say that in individual accounts, I pass a journal entry which says receivable debit, revenue credit. I need to use spot rate on the date of sale. Then at the reporting date, since this receivable is a monetary item, so under IS 21, I will keep it, I will convert it using closing rate, and any exchange difference. From where do you take this exchange difference? Statement of profit and loss, right? This is what you will write. Then how do you deal with intra-group sale? This is since parent was selling goods to the subsidiary which was located in abroad. No need to do calculations, just explain in theory. Intra-group sales in statement of profit and loss, group statement of profit and loss. Remove the intra-group sale from revenue. Remove that intra-group sale amount from cost of sales. What do you do with PORP in group accounts? You remove the intra-group sale amount from revenue from cost of sales. PORP, that is provision for unrealized profit, is added to cost of sales. That's it. So just explain this. I think it's for very less number of marks, so no need to worry. You can just explain this and get your 7 marks. Awesome. Done with question number 3. Discussion part, right? Let us move on to the last question, question number 4. So this relates to sale and lease back. What is there in sale and lease back? Let's check that out. First, the requirement. In accordance with IFRS, discuss how an entity assesses whether the transfer of an asset qualifies as a sale. So what are you supposed to write in this? If I just copy this whole thing in my response option, it's a very easy question. So my first, second, third, and fourth point. Yes. So what I'm supposed to do here? Come on. Tell me in the chat box, how do you identify whether it's a sale or not in sale and leaseback? How do you identify it? Yes. Yes. Very good. So how do we identify our sale is there or not? We refer to IFRS 15. So you will just mention here, refer to IFRS 15, definition of sale, definition of sale, where we talk about whether the control has passed or not. Whether the control has passed or not. You need to identify that. So you can talk about the indicators of control being passed. So talk about indicators of control. What are the indicators of control passed? Risk and rewards are transferred, possession is given, payment is received, blah, blah, blah. So those are the points that you will talk about for the indicators of control. Then explain how sale and leaseback transaction are dealt with by the seller or the lessee in accordance with IFRS 16 if transfer is a sale. So how do you treat it? If transfer is a sale? If transfer is a sale, the seller who is a lessee, very good. First of all the people in the Zoom meeting are quite active and replying. What about the YouTube live? Huh? Silent. No ideas. Okay. So transfer is a sale. Seller who is a lessee, first of all, de-recognizes the asset and recognizes a financial asset. That means a receivable. So that's what they do. And then what else happens? They record their lessee accounting. What do they do for their lessee accounting? For lessee accounting, they record a ROU and lease liability. How do you calculate the ROU? ROU is equal to PV over FV into CA. Come on, you're my students. That's how you calculate. PV over FV into CA. PV is present value of lease liability. FV is fair value of that asset carrying amount. That means the cost. Right? So that's what we do. Then what else? PV over FV into CA. Lease liability. How do you calculate lease liability? How do we calculate lease liability? Present value of future lease payments. Simple. Balancing figure would be profit or loss on disposal. Then you will write if the transfer is above fair value, what is it treated as? If the transfer is above fair value, what is this? Come on. Transfer above fair value. Additional finance, financial liability. Very good. That's a financial liability, or we call it as additional finance. If the transfer is below fair value, what is this? Prepayment. Very good. It's a prepayment. Yes. Then what will I do next? What will I do next? Now I need to determine what is happening in the case study. Let's apply our concept in the case study. Let us read the exhibit. Sale and leaseback. On 1st January, Beneteau Company sold its head office at a carrying amount of 3.75. So carrying amount is 3.75 and we sold it for a cash of 7.5. On the same date, Beneteau has entered into a contract to use the head office for 20 years. So sale and leaseback with annual payments payable at the end of each year. Both companies have correctly accounted for the transaction as a sale and leaseback. Fair value of the head office is 6.75. So in the question, it's given to me that the fair value is 6.75 and I have sold it for 7.5. It's above fair value. So you will write Beneteau has sold the head office above fair value. So the additional amount is treated as additional finance. What is the finance amount? My fair value was 6.75 and the transfer happened at 7.5. So 7.5 minus 6.75. Come on, what is the additional finance? 7.5 minus 6.75. What is my additional finance? What is my additional finance here? 0.75 is my additional finance. So what will be my ROU? For that, I need to adjust my lease liability. What will I do? Come on, tell me. How will you calculate? How are we going to calculate this? So if I have to calculate my present value of lease liability, is it given to me? The present value of the lease payment is given to be 5.47. So from 5.47, what will you do? Present value is 5.47. Let's first note that down. And what is my ROU? PV over FV into CA, right? So what's my carrying amount? My carrying amount is 3.75. So carrying amount is 3.75. So what would be my ROU? My ROU would be PV over FV into CA. So what is my PV? My PV is 5.47. My fair value is 6.75. My carrying amount is 3.75. What is my ROU coming out? What's the ROU? Yes. I do this way is coming out to be 3.04. But what we missed is that from our lease liability, we need to deduct that 0.75. What is 5.47 minus 0.75? Because that was additional finance, that was not lease liability. So it is 4.72. Now put 4.72 as numerator. Additional finance is not lease liability, that's why I removed it. So what is 4.72? Just for the calculation of ROU. What is my ROU coming out to be? 2.62. 2.62. That's my ROU, right of use asset. Right? Now, what will be your journal entry? Assuming transfer was at fair value. Assuming the transfer was at fair value, your journal entry would have been bank debit, ROU debit, PPE credit, lease liability credit. Where your bank would have been, what's your fair value? 6.75. ROU would have been 2.62. Your PPE would have got credited by 3.75. Your lease liability, which includes financial liability, right, would have been, total would have been 4.72 plus 0.75, which is 5.47. Correct? So can you calculate the balancing figure? What is the balancing figure? Since you have taken the full lease liability here, you can rather take this as the actual proceeds. So my actual proceeds are as per the question 7.5. See, I am taking the financial liability already, right? So I am taking everything into account. Then why to assume anything? Now tell me, what is your profit or loss? Is it a loss or is it a profit? On the debit side, my balance is 7.5 plus 2.62. What's the balance on the credit side? 3.75 plus 5.47. Gain or loss? 0.9 gain or loss? Gain on disposal. 0.9. So this is how we calculate or pass our journal entries as, okay, because I took this financial liability thing into account, because I took this full figure, okay, 5.47 in full in account in this journal entry. Therefore, there was no need to assume that transfer is at fair value, because you've already accounted for the over and above amount above the fair value. So the actual balancing figure is your gain on disposal. So these calculations, I'm writing this note for you in exam. More credit was available for explanation rather than mere calculation. Calculation carried just 1/3 or even lesser than total marks. So your easy way of passing was just putting this entry out and just explaining this theoretically. Right? Okay. Fine. Next. Explain how sale and leaseback transactions are dealt if the seller or the lessee, if the transfer does not qualify as a sale. How do you treat it if it is not a sale? How do you treat it if it is not a sale? Do not de-recognize the asset, rather treat the amount received as a financial liability. So in this case, what would have been my financial liability? Bank debit, 7.5 was the amount. Financial liability credit, 7.5 million. The rent paid would be treated as interest on loan. Simple. Then next question says, explain the effect of accounting treatment if there was any call option under the seller or lessee can at its option repurchase the property. So what do you do there? If you have a call option, if we have a call option, that means we sold our property, but then we have an option to repurchase it. Which standard is that? Come on. This paper's favorite standard was IFRS 15 only at the end of the day. Sale and repurchase. So we'll refer to that. If in a given arrangement, the seller has an option to repurchase the asset at any time in future, then it is treated under IFRS 15 sale and repurchase arrangement. If seller has an option, has a call option, then as per IFRS 15, the sale has not occurred. The sale has not occurred because practically the risks and rewards are not transferred, because you still have an option to call for your asset back. If, what's the rule? If it is not a sale, then under IFRS 15, the following rule applies. What is the rule? They say, if repurchase price is greater than the original selling price, then what is it? If the repurchase price is greater than the original selling price, it's a loan. It is treated as secured loan. Yes. Then if the repurchase price is lesser than the original selling price, then it is treated as a lease. Thus, a sale and leaseback arrangement needs to first undergo the IFRS 15 rules for defining the transaction as sale. If call option is attached, then it is not a sale, and thus rules of transfer is not a sale applies, where consideration received is treated as loan. However, if the repurchase price is lesser than the selling price in case of call option, then it is treated under IFRS 16 general lease and not sale and leaseback, because sale is not happening. So in any point we cannot say that it is a sale. It is not a sale. You have just given it on rent. It's a general lease. Rather, you become a lessor. So you have not sold it. You've rather given it on rent. That's why you're receiving money. You're becoming the lessor. You become general lessor. But this is not a sale. Whenever a call option is attached to it, it is not a sale. Rather, you are giving it on rent and not taking it back on rent. And you do the lesser accounting since you are giving it in rent. Yes? Do we all understand this? Come on. Do we understand this? A very difficult point here. I do understand this was a little tough question, but still easy marks were available where you were simply supposed to write about sale and leaseback. When the transfer is sale, when the transfer is not sale, then you would have simply written about sale and repurchase. Let a part be its application. Even if your guys' applications were going wrong, you could have still easily secured a pass mark. So we started with 200 participants watching us, and after 3+ hours of session, we are left with 100 people, approximately 110, both Zoom and YouTube. So kudos to all who attended it till the end. The small parts of this question paper I've left on to you to deal with them yourself, okay? Major parts, the passing marks and the major difficult bits I've covered, especially the pre-populated question, that too of cash flow. So towards the end of this session, now I just want to give you one advice that whenever you are solving your SBR paper, what you have to do is keep a track of time. See, I did this session in 3 hours. So I was explaining also. I've not written every requirement, I admit that. But I was explaining also, there were doubts also. So practically you have to complete it in 3 hours and 15 minutes. So come on, start. Tell me from majority, when is your exam starting? What's your time slot? When does your exam start? 9 a.m., 2:15, blah, blah, blah. What's the timeline? 9 a.m. Okay, let's take 9 a.m. as base. Whatever time, let's suppose it starts at 9 a.m. My question number 1, that is on pre-populated spreadsheet, should be done in how many minutes? 54 minutes strictly. There is no reading time. There's no reading time. As soon as you open your question paper, you have to start with question number 1. Nobody will check what is there in question 2, what is there in question 3. Is there something that I'm missing out? No. If you check question 2, 3, 4, you will feel anxious. Reason, if let's suppose a topic is tested, you saw this question. This loan part was horrible. I admit it. It was the bouncer part of this question paper. So in the real exam, you could have cried over that loan part, that credit impairment part. The sale and leaseback was still manageable. So you are not supposed to read 2, 3, 4 at any point in time. You just focus on question number 1. Give quality on question number 1. And reality is, there's a less likely chance, there's a very less chance that a bouncer is put in question number 1. It doesn't happen because groups are groups. What maximum can you do to a group? It will remain consolidation only at the end of the day. So question number 1, 54 minutes means I'll start at 9 a.m. I'll finish it by 9:54 a.m. Question number 2, 20 marks ethics. Remember that question which I did? that finance director. Professional marks are available, so you have to give a little bit of more time to it. 20 marks means 1.8 minute per mark, 36 minutes. So from 9:54, how many? 36 minute means 10:30. Please correct me if I'm wrong anywhere. 10:30 am. Question number 3. 25 marks, 45 minutes. From 10:30 am till, what is my 45-minute limit? 11:15. Yes. Then question number 4. How much? 11:15 till 12. 45 minutes. And we are done. So this is how you have to complete your paper, and in reality, in CB, you're getting 3 hours only. 10 minutes are just like time pass if you're giving it in center based. So you are supposed to complete your paper within this time frame. Each question you have to do timed practice. Now, if you guys are solving Super 20 questions, or if you guys are solving your any mock, pre-mock, I'll be solving pre-mock with the students who are in the batches. So we will do this timed practice. Whenever you are giving a mock, any assignment, do the timed practice. Because major part of SBR is time management. If you are able to do it, you are done and dusted. Right? So this is what I wanted to discuss with you and cover with you. Those who are watching on YouTube and those who are here. Those who are my students who were supposed to come in this session anyway. But the people who joined, self-study students, thank you for joining in. I hope I didn't bore you in these 2 days and you've learned something in these 2 days session. And if you plan on to enroll with me for the June attempt or for the crash course, you all know how to enroll. It's there on the TG Prof's website. You can find the link in the description after the class. Also, please join my free WhatsApp groups. Once again, I'll put it in the description box only. So that's it, guys. See you in the grand revisions, which will be once again free of cost on YouTube as well. So that's it for the day. Thanks for joining in. And I hope everyone would pass with flying colors. All the best to all of you. Good night. It's 11:15 p.m. in India. So let's sleep now, all the Indians. The ones who are in the morning time, have a good day. Bye-bye. Date of grand session, grand revision. I'll announce. Be part of my Instagram, okay? Be part of my WhatsApp group. I have not yet finalized the dates. I'll share it. So you need to stay tuned with me so that you get notified whenever such free sessions happen. Good night, TGNs. Bye-bye.